You are listening to the Marc Guzman podcast experience. Welcome to another episode of Ask Marc Anything. It's a lovely Friday. The weather's great here in the Bay Area today, and hopefully you're enjoying your Friday, maybe getting off work early, enjoying the weekend, getting ready for the holidays, and let's just get right into the questions.
All right, so our first question is going to be what measures have banks taken to ensure that the next recession won't see a collapse of the financial market?
What the banks have done? Yeah, that's wow. This is a bit of a complicated question to answer just because the markets are so complex. What happened in 2008, just to kind of go over it very, very briefly, the financial markets and the economy is so complex that it's very hard to just point at one thing that caused it. But 2008, one of the bigger things that caused that financial crash is, and this is the best way I can explain it. So let's say I make, uh, uh, there were a lot of just bad loans just made, period. Okay. Bad loans were made, and partly was because the government really encouraged, beginning in the mid 90s, the government just really pushed a lot of banks to start lending money to lower and lower qualified people. It went from like a 680 credit score minimum to buy a house down to 660, 640, 620. Eventually made its way down to 580, which many people now know as subprime mortgages. So you have banks that made a lot of bad loans. Then, after the entire financial crash, the government came in and essentially placed so many different restrictions. One of the biggest legislation acts was the Dodd-Frank Act. And this placed so much regulation. I mean, I want to say this was thousands and thousands of pages of regulation on the banks to the point where as of today, I believe only 50 or 60% of all the laws have actually been enforced. There's so many regulations that it was just over the top. They haven't even been able to enact and enforce many of them. And now we're seeing the drawback from the current administration pulling away from many of those in order to allow the economy to lend a bit more and grow a bit more. So, um, you have the government that came in and placed a lot of limits to where you essentially saw subprime mortgages disappear. And so, what have the banks done since then? Well, they've simply just complied with a lot of the government regulations. There's an argument to be made that many of the government regulations went a little bit over the top. We all noticed that very quickly after the 2008 financial crash that all of a sudden, if you had a 600 or 620 credit score, it you couldn't buy a house anymore. You had to have at least a 640. Then even if you had a 640, even if you had a 700 credit score, there were so many other documentation and requirements needed to comply with from a homeowner to refinance or someone to buy a property that it was very difficult to get financing. You saw many people getting. I had a attorney friend of mine who owned a house in Orinda. The house was probably worth about $1.4 million after the financial crash. And he had a mortgage of like 250,000 that he just simply wanted to refinance, not trying to pull money out, just simply refinance. He was denied by 18 different banks. And he was denied not because of the property value, not because of credit score, but because he was self-employed. Many banks really pulled away from doing many loans that they considered risky, and a lot of it came down to the government regulations. So, what the banks did afterwards, they really just complied with a lot of the government regulations. So, again, it kind of went from one extreme to the next. And so, I think coming up this next recession that people are talking about, 2020, we're not going to see a lot of those same issues as 2008 because there were just not many bad loans made between after the last financial crash and today.
So I guess we won't see any mass. Yes, that's good. We won't see any massive collapse this time, but
Yeah, I mean, for a massive collapse, for sure. I mean, 2008 was so unique in the way it was actually put together. I mean, it ended up being what you would call like a perfect storm of just all these different issues building up and causing a complete housing crash. Now we're not gonna see that same type of crash. I know some people are hoping for that because now they wanna take advantage of home prices dropping, 50%, 60%, and then they're gonna jump in and buy. Unfortunately, that's not gonna happen, or actually, fortunately for most people, it's not gonna happen. It's just gonna be a different type of recession, but we're seeing a slowdown right now of the housing market. The housing market's already decoupled away from the economy. Economy is still doing fairly strong. We're starting to see a slowdown of the growth, but it's still doing fairly strong. But the housing market is, it's slowing down quite a bit. How the housing market will be affected by then maybe a 2020 recession in the economy, no one really quite knows that. We can only assume that the housing market will suffer even more if the economy suffers. But how dramatic will prices be affected? You know, some people estimate we're talking about 10, 15%, maybe 20, 25% at the most. But that's it. We're not going to see anything of 50, 60, or in some areas like Richmond, California, you had some neighborhoods drop 90% in value. We're not going to see that.
do you think the next reset? What industry do you think the next recession is going to hit first or hardest?
Well, the thing is, the recession hits so many different industries. It's not just one industry. Everyone associates a financial crash with 2008 with the housing industry because that played a big role in it. And we saw prices drop very dramatically, right? But if you really look at it, there were so many different industries that were affected by that crash. It was not just housing. I mean, you had almost every industry. I mean, unless you ran a business within an industry that prospers during the recession, then you were probably okay. But when a recession happens, almost every industry is affected.
So this next question is playing off kind of what was discussed on Highest and Best on Wednesday in terms of student loans creating a liquidity crisis. So the question is, how might student loans have a similar impact on the economy as subprime mortgages did back in 2008?
Okay, that's a good question. And I think the answer is it won't have an effect similar to the subprime mortgages, but it will have a completely different effect. And the scary part is we don't know how it will really affect the economy. Subprime mortgages. So to add a little bit more to what we were just discussing, the problem with the 2008 financial crash and why subprime mortgages played a big role in it is, and it can get a little complicated to explain, so I'm going to explain the best I can. So let's say I'm a lender and I make an investment. So I lend money to somebody, they owe me a debt. Now that debt is an investment vehicle. Well, I can make a good investment vehicle or I can make it a poor investment vehicle. Obviously, I want to make it as good as possible, but there is money to be made when making bad investment vehicles. How? Simply by the secondary financial markets where I make an investment and then I resell that to another investor. So if I make a bad investment and I go to you and I try to sell it to you, you're likely not going to buy it. Well, the financial markets decided, well, what if we combine this bad investment with other types of investments that might be better? And if we combine them as a package, we can then make these bad investments, aka subprime mortgages, and mix them in with other good or okay investments. We get them graded, and then we can sell them off as packages. These were known as collateralized debt obligations, CDOs. And this is a whole process of securitization. So if you've heard those terms, that's essentially what it was. And so they would take these bad debts, mix them into packages, and sell them to you. Now, you as an investor may say, yeah, I'll invest and buy this entire portfolio because there's enough good debt here that I think it will offset the bad debt. Or by taking it a step further, you can then get insurance on this portfolio. So let's say you purchase this entire portfolio of debt, which included good and bad investments. Well, you then turn around and go buy insurance against any losses on that investment. So a company that was very big and famous for doing this was AIG. Now, AIG was not the only insurance company, but there were many insurance companies that were doing this exact same thing. And they were selling insurance and making billions and billions and billions of dollars simply selling insurance to people to cover their losses on these packages. Now, when the economy's great, everything's running like like clockwork and everyone's happy, there's no issues and insurance companies are making a ton of money. And so the problem the problem that on the insurance side is they were insuring way more than what they could cover. And that became a problem that we saw when the economy started to slow down and we started to see a lot of defaults in the subprime mortgages because now these package debt obligations, now you're starting to see losses in some of these. So many of the investors decide, fine, no big deal. I just go to the insurance company, file a claim, and cover my losses. Well, what happens when too many people do that and the insurance company has over leveraged themselves? Now you end up with an insurance company that cannot cover their own obligations, which is exactly what happened with AIG. And so they're faced with either, hey, we need a bailout, or two, we can't pay anyone their losses. And if they can't pay anyone their losses, all the investors then get stuck with all this bad debt, which then affects them and their own books and their own investments and financials. And it just snowballs into this one big giant shit pile. Yeah, shit pile. So that's essentially what happened with the subprime mortgages and the 2008 financial crash. Now, going back to the question of how student loan debt will affect it, it's going to be completely different, and we don't know how it's going to affect the housing market or any future financial market because one thing that's very unique about student loans is that you cannot file bankruptcy against student loans and get rid of it. It follows you for life. Unless there's some kind of legislation that comes down the road that modifies that, until that happens, there's nothing that can be done to get rid of student loan debt. You essentially have to pay it. Now, if you cannot afford to pay student loans off, you're then left with the fact that you cannot buy a house, you sometimes cannot qualify for certain types of loans or credit cards because, well, you have to pay it off. They see that lenders will see that as a risk. You have to pay that off in order to qualify for one of their loan products. So then that restricts the amount of capital that's actually lent out and that you as a consumer can actually have available to then do what consumers usually do, spend the money. And so then you have less money in the system and you have a restriction, and that's essentially would be a recession caused by that liquidity issue, which is why many economists are now saying that 2020, when that recession hits, we're going to see a liquidity issue build up from it because student loans are in the, I don't know the exact number, but we're talking about trillions of dollars worth of student loans on bank books and also owed by American people. And so if you have to pay that off first in order to move forward in other industries like housing. Well, when your average home buyer is 32, 33, or average first time home buyer is 32, 33 years old, someone who's graduating college right now, 24, 25, 26, in 5 years, 7 years, 8 years, they're going to be at that age of being a first time home buyer. They may not have all their student loan debt paid off. And guess what? If they don't, their down payment that they've saved up is going to go toward paying off that student loan. And then they have no money for a down payment, or these simply just don't buy a house. And if you have the first time home buyer market reduced by the number of qualified people, that will then lower the actual demand for housing for the resale housing market, and you'll see a drop in housing values because of that. So that's how the student loan market could affect the housing market. but no one quite knows because it's something that we haven't really seen. The I think the student loan the financial industry that lends out to student loans has been such a ripoff for many years, and there's many colleges that simply know this and have taken advantage of it, and they it's just gotten out of control. In fact, I believe John Oliver, if you watch HBO's Last Week Tonight, John Oliver did a great 25-minute segment on student loans and how it could potentially affect the economy. And basically, he broke down how it works, and it's a mix of like a Ponzi scheme with like loan sharks in one business. It's pretty messed up, and so um, it is what it is. That's built up to trillions of dollars worth of debt that will have some kind of effect. If the government comes in and says, "Okay, we're going to change the rules and allow people to file bankruptcy on it," here's your other problem: people file bankruptcy and they're not paying their student loan debt. Well, who holds that debt? It's going to be banks, but do the banks really hold the debt? One thing that many people don't realize is that just because you get just because a bank gives you money for a student loan does not mean they're going to hold on to that debt forever. Many times that debt is also sold off to other investors. The bank may still hold the servicing rights, meaning you pay them for that, you make your monthly payment to them. But many banks will sell off the servicing rights. That's a whole nother industry in itself where banks can even, let's say they make $1 million a month in fees that they collect in servicing different loans. That doesn't mean they own the loans. They're just like a property manager for the actual loan, not the property itself. They could also take loans on those servicing fees, and they can there's a whole nother financial market that in industries that are built on simply financing and making loans against servicing fees. And so if the bank is not collecting fees, well, the investors hit. Well, then it comes down to who's the actual investor and how will it affect them, and they need to get this debt off their books. And so if you're able to file bankruptcy or the government comes in and just wipes out all that debt, now you might be wiping out a whole nother sector of investors that then at that point could have a major impact on the financial economy. We may be looking at another bailout, and that bailout might be a lot bigger than what the banks were bailed out with in 2008.
Seems like another thing to blame millennials for.
You
All
know
that
what?
student loan debt.
No, it's not even millennials. It's really not millennials' faults, or I mean, it was just really bad policy, and a lot of the people that were in charge of making these loans were older generations, not millennials. Millennials were the ones going to college, or the what's the generation after millennials? The
Gen
younger one,
Z.
Gen Z, going to college, taking out all this debt. But one of the problems that we've had here in America is that since what the 50s and 60s, it it's been ingrained in everyone's head that you have to go to college. You have to go to college. You have to go to college. And it's stupid, it's idiotic. And the answer is no, you don't always have to go to college. Yes, sometimes you do. Depends on what you want to do. If you want to become a doctor, yes, you need to go to college. Attorney, same thing, go to college. But if you want to be a real estate agent, no, you don't need to go to college. You want to be a plumber? No, you don't need to go to college. Go to vocational school. That's one thing that we've lost are many vocational schools because everyone's been pushed to go to a higher education learning. The problem though is we've seen this develop over the decades. We now have an oversaturation of people with degrees, and really there's quite a few degrees that don't mean anything. They don't give any value, and unfortunately, you can't do anything with it. It's just very expensive knowledge. And with the internet, guess what? A lot of that stuff is already out there for free if you look for it. So, unfortunately, the values of degrees and that higher education has been so devalued, yet the financial system has been taking extreme advantage of it. And you've seen costs of colleges just increase, just skyrocket to ridiculous levels. The value is not there, and we're at a point where the value of a degree has dropped, the cost of education has increased. You've got a giant bubble that's eventually going to crash, and that's what we're going to see here in the next 5 to 10 years.
Fun.
Yeah.
All right, so our last
It's a
question.
shitstorm, remember.
Yeah, that's putting it mildly. So last question: how do you know if you are ready to make the jump from renting to buying?
Renting to buying. So, the number one thing I tell people is there's a big idea, a big there's always been a big push toward home ownership. There are reasons why. However, I think people really need to get out of that mentality that you have to buy a house. Even if you can qualify for one, does not mean you should buy a house. Buying a house can be expensive. In the Bay Area, most properties you can rent it out for less than the cost of home ownership, even after you calculate the tax savings on your mortgage interest deduction. It's you do the math based on uh, what it would cost to rent, based on what it would cost to purchase the same property. It's going to be cheaper to rent, even though rent prices are high. They're still not as high as property values and what your mortgage would be, or you have to come in with a huge down payment to make it equal. And at that point, well, what's the cost of the money to you now compared to the future? It just doesn't make sense. So, what I tell a lot of people is when you when you're dealing with this question, it's not a clear cut answer, and it varies person to person. If you want to buy a house, fine, but just understand that it shouldn't be your main priority. Finding a house that you're okay with, that you love, that you wanna live in, that fits your criteria should be your main priority. Whether you rent or buy should be secondary to you making that decision. Uh, Remember one thing: when you buy a property, you're then in charge of everything that goes wrong with that property. When you're a renter, you're just paying your rent and that's it. And you have the flexibility of moving. As long as you're month to month and not on a fixed term lease, you have the ability to move. If you want to stay at a property longer, negotiate a long term lease, a 2, 3, 4 year lease, and great, you're guaranteed to stay at that property because you have a fixed term lease. When you buy a property, you're in charge of fixing the heater if it goes out. You're in charge of fixing broken windows. You're in charge of landscaping. You're in charge of everything, plumbing issues, everything that comes with the property. Now, there are pros and cons to both sides. And one of the pros of owning the property is that you're able to lock in your actual monthly payment, right? Whereas when you're renting, especially if you're month to month, you may have yearly increases. Now, if you have a fixed term lease, then whatever the lease states your rent payment is, it's there. So you could negotiate a fixed term uh, lease agreement with no rent increases. Most landlords will want a rent increase, but you can at least have some control over that. Whereas once you buy a property, if you're doing a standard 30-year mortgage, your payment is going to be fixed. So there's pros and cons to both. There also, one of the pros of owning the property is that you can do whatever you want to it for the most part, as long as you don't violate any city codes or uh, zoning laws. So you could paint, you could remodel the kitchen, you could do various different things, and you don't need to have someone's permission to do it. So you are allowed some flexibility, but once you buy a home, you're stuck there until you can sell it, and the home values fluctuate with the housing market. And so if you have a recession or if the housing market starts to slow down and your values drop, now you might be stuck in keeping the property until values come up. Well, what if there's something that requires you to move, job relocation or just personal matter? It's a lot harder to move when you have a house. And if you decide, well, I'll move and I'll just rent my house, usually that rent payment is not going to cover your mortgage and other expenses, and you end up with a negative cash flow situation. So there are pros and cons to both. I think the number one thing is don't get stuck into the mentality that you have to buy. Number one. So let's say you're renting and you do decide you want to buy a house. Okay. Number one is you need to understand the cost of entry. So you're going to need your down payment. At minimum, for if you want to do FHA financing, at minimum, you need 3.5% down payment. You're most likely going to have to figure another 2 to 3% in closing costs. You also want to figure out home inspection costs. Home inspections can range for a home termite roof can range anywhere from $600 to $800 as a package deal. And that's if you spend that money on only one property. There will be cases where you're looking at properties, you decide to offer on the property you like, you spend $800 on inspections, and something comes back that, hey, there's a $25,000 termite report on this because there's so much dry rot, bugs, and issues. Now you may not want to buy that house anymore. So then you back out. Then you go back on a home search. You find another property. Now you make an offer. Guess what? You're spending another $800 on inspections all over again. So you have to budget for multiple properties sometimes, just for inspection fees. And that I think the biggest obstacle for most people is really that down payment, just saving up the down payment to get into the property. But talk to a loan officer earlier than later about qualifying for a home purchase, because there's a lot more to getting financing than just having the down payment. Sure, the down payment is great. I mean, if you have it, great. But there's also credit score. Credit scores also affect the interest rate that you get. Higher your credit score, the better interest rate you can get. If there's multiple buyers, they're going to go off of the lowest credit score. So if you're a couple buying, you want to figure out who's got the lower credit score and try to work on pushing those scores up. So there's credit score. There's also your income. Well, how much is your income? That's going to determine what the max potential debt you could have. Then what's your current debt? How many car loans do you have? Do you have maybe another mortgage or whatever the case is? You then have to calculate all this debt, and this goes into how much you can actually qualify for another purchase. Uh, all these different things go into play, including how long you've been at your job. If you just got a new job, got maybe a better position than your last occupation, but you've only been there for a year, you may have to wait a whole another year before you can qualify for a mortgage, because some banks will require 2 years worth of the same occupation for you to qualify. So there's a lot of different variables. So if you're dead set on buying, you've ran the numbers, compared renting to buying, and you're still stuck on, okay, I want to buy a property. Great. Talk to a lender now. Find out what needs to be done, because they can also give you advice on where you need to be, and that'll give you basically the plan or an idea of where you need to go to get the best possible loan, the loan rate, and that's I think probably the best piece of advice. Down payment, talk to a lender now, sooner than later.
Awesome.
Great. So thanks for watching another or listening to another episode of Ask Mark Anything. Have a great weekend and enjoy the beautiful weather. I think it's supposed to be sunny all weekend, right?
Maybe some rain on Sunday, but
Okay. Light rain.
probably not gonna be any rain though.
Yeah. Great. And then hopefully stock market is it's going to get a rebound next week. It's down 4% this week, but thank you so much for listening to the podcast. Thank you to our producer, Sam Lubman. Please subscribe, like, comment, and share the podcast. Remember, you can listen to the podcast on iTunes, Podbean, iHeartRadio, Google Play, SoundCloud, and anywhere else you listen to podcasts. For more information on my business as a property manager and real estate team, go visit my website at markguzman.com. I really want to thank all of you for listening. It means the world to me, and I hope today's episode provides you value in your day-to-day life. I created this podcast to help showcase the many great people that live in this world and help share some knowledge that I've learned along the way in life. Again, thank you for listening. Check out our sponsors, and I'll catch you on the next episode.